Hello channel members. On March 4th, 2025, I updated my Palantir discounted cash flow valuation model, and there was a big upgrade in the intrinsic value per share. So I wanted to share with you this update to that valuation model. So the biggest changes came from the expected free cash flow that Wall Street analysts are estimating for Palantir stock. They received big upgrades in those expected free cash flows between the years 2025 and 2028. So those newer cash flows are now $1.51 billion expected in 2025, 1.83 billion in 2026, 2.59 billion in 2027, and 4.39 billion in 2028. I'm forecasting that the company's free cash flow will continue expanding for several years into the future, rising by 21% compounded annual growth rates between 2028 and 2034, before settling down to a 6% longer term growth rate in free cash flow starting in 2035 and beyond. That means the present value of all of the free cash flow that I expect Palantir will generate between today and the very, very long run is $110 billion. Now, the discount rate I applied for Palantir stock is 13.03%. I've given them a cost of debt of 6.5%. Even though they have zero debt, they have a pristine balance sheet with over $4.5 billion in cash and zero debt, and the company's already cash flow positive. So they are a relatively low risk, even though they're relatively low risk from a lender's perspective, even though they're very high risk from a equity investor perspective. Because from a lender's viewpoint, this business generates billions in free cash flow, has almost $5 billion in cash and zero debt. So even if this company were to experience, let's say, a slowdown in the growth rate, which would hurt the stock price, it wouldn't really hurt the company's prospects in paying down debt. And so it's a low risk debt company. And so I've given them a low cost of debt of 6.5%. And I expect at some point in their future, they may want to borrow some money because look at their cost of debt, 6.5%. The cost of equity is 13.75%. The stock has a very high beta. The stock is really risky. So they can change and alter their capital structure to lower their overall cost of capital and thereby make their investment, make their stock more attractive to investors. So their market cap, as of the original recording, was $159 billion, and I'm giving them a target capital structure of 10% debt and 90% equity. Even though they have zero debt right now, I'm giving them that target capital structure because of the big difference in their cost of debt versus the cost of equity, and management being smart financial participants, they're going to realize this as an opportunity to borrow money and lower the weighted average cost of capital, which will increase the company's valuation. So eventually I expect they will borrow money, even though they don't need to. They have plenty of cash on the balance sheet, and we'll see here over $4.5 billion in cash and zero debt. So the value of equity came in at 114 billion divided by the number of shares, 2.46 billion. My intrinsic value calculation came in at $46.70, which was a big upgrade in today's price. I previously had the intrinsic value calculated at around $26 per share. And so now I upgraded that by $20 to $47 a share. Still, when you compare it to the current market price, the stock looks overvalued. And I've been saying for nearly all of 2025 that Palantir stock looks overvalued. And you're seeing some of that reflected in this big dip in Palantir stock price in recent weeks. It's mostly because I think the stock is very overvalued. Well, I shouldn't say very overvalued now. It's just overvalued now. Its current market price is $84 a share, and my intrinsic value calculation has it at $47 per share.